show me someone that will do this for 7 years, 7 years, just to build a banking system. And I will show you someone that has conquered Parkinson's Law.
If you're really going to make a difference long term, universal truth out there is that, anything worthwhile doing takes time, dedication, and effort to get it done.
Canadians have a really good reputation of paying their bills. So we have to take that exact same brain power, that exact same programming to implementing the process of becoming your own banker.
I've got two of my amazing colleagues with me. I invited two wonderful fellas. I've got the dazzling Dan Allen and the vibrant Vern McCarty with me here today. And we have an interesting topic. So, Dan kind of had this come up, a question recently from a client. And these are the kind of questions that we do get from people from time to time. And I thought it'd be a good discussion point for us today on our live chat. And so, Dan, why don't you hit us up with kind of the overarching, we won't go into like the detail aspect of the question, but just, overarching, what was this commentary all about, and had a reference to Nelson's book?
That's a great question I got from a client, and I just go, okay, this is, first off, he was really intent on learning. And so he was taking in a lot of content. He was taking in a lot of our great videos. He's been reading a multitude of books. And of course, the book that we all go back to as kind of the foundation, which is, Nelson's book. That's exactly it, called Becoming Your Own Banker. So he was diligent in reading that. And he said, there's a bit of, I just have a question for you, Dan. And that question is when I read Nelson's book and all of his examples, he shows capitalization and then utilization. And a lot of the other publications and even videos, I'm learning from them that I can start utilization early on. Like it doesn't show no 4 or 5 year capitalization phase. It shows use. And so this client was just a little bit taken back about the difference in the message. And he's saying, so can you help me understand why is there that difference between the way Nelson spoke about it in his book and then some of the other great resources that are out there that are helping our clients every day get better at this process, where we show them how you can start to utilize the equity capital that they have built up right away. So that's kind of the essence of the question. Why is there that disconnect between Nelson's book and some of the other stuff you hear out there about how long you have to capitalize before you put your money to work?
What's really interesting is a lot of our video content, even you're talking about content resource, so our content on the Banker's Vault channel, the podcast of Wealth Basement, we talk even about utilization right away. And one of the reasons for that, of course, is that, especially when people are first learning this, a lot of times we don't have maybe the patience level that people used to even 20 years ago. Everything's an I want it now, mentality. Like if you're walking around and you've got one of these magical little computers in your pocket, and it's like I had a conversation with some family members over the Christmas holidays about how, like, oh yeah, you pay for all these things, you get your phone, you pay for all this stuff, but like you don't even, like, I just want to call people, like some people who just want to use it as a phone, but you can't go buy a normal phone anymore. You have to get an entire computer that replaces a camera and an alarm clock and like your wallet in some instances. Like it's got every gadget under the sun. It's your communication platform. You can run your business off of it. Like it's all of these things. Well, of course, that's why they're like $1,000 to go buy them outright. And so we don't live in a patient society the way that we, used to, certainly when Nelson grew up. And so Nelson even references that in the book about how our thinking has to be adjusted a little bit. And he specifically talks about human condition. He mentions a number of them. And one that's a huge focus is Parkinson's Law.
Yeah.
So Parkinson's Law talks about a variety of factors, and, expenses rise to equal income. I'm sure if you're watching this, you've experienced, that in your own life. Hey, you got a pay raise. Great. Where does it go? I don't know. It just disappears into the budget, and all of a sudden you're wondering why the Tim Hortons cups keep piling up in your garbage more than they did before, and, more Starbucks and stuff. And
why you have an extra set of keys in the drawer there? Car keys.
Extra car keys. That's right. There's a hot tub all of a sudden that showed up in your backyard. Interesting. Where did that come from? Right. So we wonder where the money goes, and that's what happens. Like our natural condition is, to find a way to put that to use in some way, whether it's good use or bad use. That's something you got to decide for yourself. But Nelson even indicates, and Dan, you and I were talking about this in his book. We'll talk about one of the examples, the twin sisters, which is on page 45 of the book. Right leading up to that on page 42, you and I were trying to look for it. And like in my book, it's all like, I've got all these highlights kind of here. So it's right in this section. And I'm like, oh yeah, I have that highlighted in 2 different colors and underlined. Imagine that. So this is on page 42, and it's on the first column, about a third, 2/3 of the way down the page. It's talking about 2 twin sisters, and they're accumulating money, and their goal is to self-finance cars throughout their lifetime. That's their sole goal, sole objective. Nelson says, person accumulates money on a monthly basis in a savings account and then buys a certificate of deposit, which is a GIC in Canada. It's the same thing, at someone else's bank in the amount of $5,000 a year. So every year you're putting money away saving, then annually you go get a GIC, and then you do that for a number of years. Show me someone that will do this for 7 years, 7 years, just to build a banking system. And I will show you someone that has conquered Parkinson's Law. Brilliant. He will win by default in comparison with his peers because they cannot discipline themselves to do so. The whole idea here, what Nelson's really trying to teach us is he's not saying that you can't use the policy earlier, your banking system. He even shows you how to create a banking system without an insurance contract. It's just less efficient than the insurance contract. So like if you're going to choose 2 different options or 3 options, like your shoebox and a Safeway bag tucked underneath your bed or whatever, it seems like a really dangerous place to leave, loose cash lying around. But, you could bank out of that like a shoebox if you really wanted to. But it's not very efficient. And then if your house burns down or you get like the flooding like we had around Chilliwack, I mean, you're going to have a big problem with all that capital. Of course, the new Canadian money would probably float pretty well. Seems to do okay if it goes to the washing machine. Yeah. But the key thing is you got to conquer Parkinson's Law. He's not saying you can't use it earlier, but if you can't demonstrate the discipline of continued capitalization over a lengthy period of time, 5 years, 7 years at minimum, then you're going to create problems in your own life because you can't discipline yourself to do so. That's kind of the general premise. So
I was thinking as you were talking to Richard about, Nelson's golden rules. And one of the ones he put a lot of emphasis on is don't be afraid to capitalize. And I think that's part and parcel of really when you think about what he was trying to educate us on as he went through his presentations, it was really trying to help people understand that if you're really going to make a difference long term, universal truth out there is that anything worthwhile doing takes time, dedication, and effort to get it done. And so he really wanted us to think about that human behavior. How do we overcome that that desire that we all have? It. I think we've all experienced it where we get money and it's like we can spend it and the next thing you know, it's gone. And he's thinking about the future. Think long range was another one of his golden rules. Like think long range. And I think why he demonstrated that in his book, for me, that's a big part of it. And the other piece, and I think it goes well to his second book, which is, building your warehouse of wealth. It's like the opportunities that will seek you out when you have a pool of capital that's readily available compared to someone else that may not have access to that capital. I think that's where, people get hung up on rates of return. Well, it's not about rates of return. And, in this product, it's about capitalization and what you could do with that capital. If you've got an opportunity that you can change, a financial outcome in your family or in your business, and you can do it right away because you've started to capitalize the system, well, that's an opportunity you don't want to let go.
A couple things that I want to share. The first thing is, Dan, I want to acknowledge you and I want to acknowledge your client. They did the right thing. First thing you said is, hey, I've been watching videos, and they studied. They're starting to learn the process. This is called becoming your own banker. It's not like, hey, I want to buy one of those banking things and you give the guy the money and you set it and forget it and walk away. It requires continued learning, continued education. It's a lifestyle. It's something that you're going to study your entire life. And the second thing that your client did that was really smart is not trying to do it on their own. They actually reached out to their coach and they said, hey, coach, what's going on here? This capitalization thing. And some people are talking about using it right away. And how does this all work? So I think that's really brilliant. And what I'm going to expand on in my own mind is one of the questions, I'll be totally straight with you guys, drives me mad when people show up on a call and they say, so how long do I have to put premium in, Vern? I go, look, it just keeps getting better. So if this thing just keeps getting better, I keep pumping it in, and my return on those dollars, my return on effort, the amount of capital that I can access is just going to expand over time. Why on earth would I want to stop putting fuel in that thing? I am never going to stop capitalizing. So that's one of the things I think sometimes people collapse when they read Nelson's book and they go, oh, capitalization period. Oh, I only have to put premium in for 5 years or 7 years or whatever that number is. Well, yeah, but if I put it in 8 and 10 and 11 and 21, it's just going to get better. So why on earth would I ever stop? So let's not collapse that. And Nelson's just trying to isolate some specific points in his book. And he's probably making some assumptions that maybe there's some missing information there. But the point is he's just trying to get people to think differently about what you're presently doing today versus what you could be doing and how you can actually utilize the system.
In Nelson's book, in all the examples where he shows, like equipment financing and you go through these different illustrations, like, wow, it's getting better. Like this person gets a larger retirement income, but people don't recognize what's happening. There's little footnotes in the bottom that talks about the extra interest. Well, the extra interest, it's in air quotes, literally, like Nelson would have said parentheses.
Yeah.
I'm lazy and I like the air quotes. So I put the air quotes up.
Yeah.
And he's saying the extra interest isn't actually interest. It is actually extra premium, which is capital, which is adding to the cost basis of the policy. It's equivalent to what he would have been paying some third party. Someone else was going to get the equipment financing guy's money. He's just redirecting the flow of the same energy of dollars into a system that he has ownership and control over in mutual free contract with a whole bunch of other people through voluntary contract with an insurance company where he gets to share in the profits. And because it's adding to the cost base, it's actually more premium going in. It increases all of the numbers and everything gets better. That's what Nelson's really trying to get people to see. And so one of the reasons why, as an example, in Nelson's book on equipment financing, he only shows premium deposits for 4 years is because he needed to be able to show not putting premiums in so that when he added extra capital in, you could see the impact of it. Right? So whereas if that person just kept funding that policy, all of the numbers would have been better than what Nelson showed in his book. In fact, Nelson does an example. He updated the book in a later revision because he kept getting questions. Well, this book was written a long time ago, and dividend scales were bigger back then. This doesn't work anymore. This isn't relevant. It's outdated. It's like, oh, really?
Yeah.
So he shows another example of adding more premium in year 5, basically doing 5 years of capitalization in the exact same example, but at a lower, dividend scale, which is relatively irrelevant. But because of that extra capitalization, all of the numbers on everything got far better, far more superior because of the way that the machine works. And so one of the things that you tied on, Vern, is that, you're never going to stop putting capital in. I don't plan to stop putting capital in either. Now, you might want to have the choice or the option to. Having the choice or the option is about control. Doesn't mean that you want to. And so Nelson, in my opinion, he says it so clearly, it's clear as day. Point number 2 on page 85 of the book. If you knew at passive income time that you would be getting back every single dollar you put into a system, potentially tax-free, would you ever object to putting more money into it?
Earlier, Dan, you said something about discipline, and I think Richard mentioned discipline. I just wanted to point this out because a lot of times people get super excited about, oh, I'm my own banker. I have all the control. I can recapture the debt on my Ford F-150, and then I can just stop making, oh, yay, I paid it off 5.5 years early. I don't have to make payments anymore. And what did Nelson say about that? Like, look, if I'm going to go in and do business with a commercial bank, I'm expected to make a payment. And what do Canadians do? We bend over backwards to pay our bills. We work really hard. Canadians have a really good reputation of paying their bills. So we have to take that exact same brain power, that exact same programming to implementing the process of becoming your own banker. If I'm going to borrow money from my system to pay off Ford Credit Canada, you better believe I'm slamming just as much, if not more money right back into my policy. I'm just going to redirect those payments and I keep that discipline going. The difference is I'm the one who gets to recycle those dollars and harness that financial energy by putting it back into a system in a company that's very profitable that I co-own. So don't steal the peas.
It's no different than if you had that vehicle payment. It was $1,000 a month for the truck payment, and you just put it back in your savings account. The only difference is if you put it in your savings account, it's not as efficient as if you put it in the policy as a loaner payment. It's the best way to save if you have a system like this. And on page 52 of Nelson's book, He says, pay close attention to this point. It is vital that you understand that he's talking about the equipment financing, he must set up a loan repayment plan that equals or exceeds what he would have had to pay a finance company that he was using in the past. His life insurance agent should coach him at this point that the policy loan interest is, for example, let's say 8%, but we're not going to play that game. We're going to call the finance company you were using and ask them what you would have to pay if you finance it with them. And of course, you're going to pay at least that or better. The more capital you put in, the better the whole machine gets, is, the summary point. So he hits these points multiple times, and he does it in different ways. And sometimes people, reading the book one or two times, it's hard to connect all the dots together.
As you were speaking there, Richard, I thought of another example that Nelson has in his book. And he mentioned this a multitude of times. I heard him say it live, and I heard him, it's in his book about, even something as simple as, the insurance that we put on our vehicles. And, he teaches you that over time, you can stop. Once you've got enough capital in your system to cover the capital loss of your vehicle, you can stop paying that collision and comprehensive insurance. And what did he coach us to do? Well, you put that money that you were sending away to someone else into your own system, so you continue to capitalize. It's about capitalization. The more capital you have, the more opportunities you have. And if you're going to do one thing in life, if you can build a pool of money, pool of capital that you can access, and better yet, because when you get to be my age, you start thinking more about, the next generation that they can utilize to help them through their financial journey in life. Once you've got access to that capital, get out, put it to use, put it to good use. But the other thing is never forget that you got to continue to put capital into your system. And I always like the look on someone's face, that aha kind of moment when you show them, hey, after 10 years, if you put your premium in again, this is the kind of value that's going to drive. And they just go oh, that's a real eye opener, an aha moment for them, because they go, why would I stop putting it in at that point? Because that's just getting efficient. Like Nelson's example of the steam, like it's got energy, it's built energy. That's page 15. If you want to read in the bottom right-hand corner about steam and just generate energy. And once it starts to get that energy going, why stop it? I think that goes back to what Vern was saying. Why would you stop putting capital in? But you can. And there might be a time in your life where you choose to. But the longer you capitalize, the more opportunities you're going to get.
And if you think about the steam engine specifically, think about a steam locomotive. How long did it take them to get that steam building so that it could get speed and get inertia? And if the person who's firing wood into that steam engine there to keep it going, if all of a sudden they take a break and go for a smoke, well, what happens? That thing runs out of fuel and energy, and it starts to just shut down. And you got to really just go and grind that out to try to get that thing operating, to efficiency again. And the page you're referencing, two of my favorite pages, page 48 and 49 in the book, and I had to flip to them. So it's expanding the system to encompass all income, and he talks about that self-insuring for automobile insurance, and he says, in time, the total cash values in all policies, so whether you have one or you have multiple, are adequate enough to take the next step, self-insuring for automobiles for comprehensive inclusion. He says, please note, I did not say liability, but he says, look, if you got a vehicle, let's say you bought it for $30,000, and today, if you could sell it, now it's only worth $10,000. What means if you're paying, $1,000 or $1,200 a year or something for automobile insurance, and usually the collision premium on that is 50-60% of the whole premium. Well, now if you're doing that for two vehicles, and then all of a sudden your kids get vehicles, and then your whole insurance rates go up. If you have $15,000 in cash values in the policy, and your vehicle's worth $10,000, and you got to pay $1,000 deductible, that means if you get into an accident, the insurance company you're paying into, they're only going to give you $9,000 because you got to pay $1,000 to get $10,000, right? So if you would pay that premium to those guys and you increase your deductible to pay a lower premium, well, wouldn't you pay a higher premium with zero deductible to yourself and put that energy into an insurance company that you own and control? It's just a great way of thinking.
Richard, I love that you keep using the word energy, because people vastly underestimate. Everyone wants to see, oh, Vern, if I pay back my loans, how's that going to impact my dividend? And like I can't, I'm not going to illustrate that. I can illustrate that. Look, how much is your dividend being impacted by flowing all of that energy to someone else's bank? How's that impacting the growth anywhere else? It's not really helping you a whole lot, right? So the whole idea is just take that energy, the life insurance company that I'm a co-owner in, they're going to put that money to work to grow more profit. And inevitably they're going to share it with the co-owners of the business, i.e. the policyholders. Same thing as they do it at a commercial bank, except you're not one of the owners of the commercial bank, right? So they're taking your capital, they're putting it to work for other people's families, all of that energy. And the last thing that I want to share about that, Richard, is I think it's awesome that every single time either Dan or I open our mouths, you're in Nelson's book pulling up the specific page, which is awesome.
Yeah.
But you talked about the steam engine. So just imagine you're saving money in someone else's bank and you're piling that money up, and then maybe it's growing, maybe it's not, but you're piling the money up and all of a sudden life happens and you need to access the cash. That's equivalent to shutting down the train. And now I got to build up all that steam again just to get the engine going, where we're taking the capital, we're putting that energy in the policy system, and I don't stop the train. I can access capital without slowing down the train. It's just going to keep on building momentum as long as I just keep shoveling the wood back in. So just being a responsible banker and sending that energy again right back to the policy.
I always go back to one of the things he said about it's an exercise in imagination. So we're only limited, that's why it's called the infinite banking concept, by ourselves. And it's all begins with the way we think. That was one thing that he constantly told us. And so there's so much within that book. And I just encourage people to go read it and reread it. Find sections that you really want to get into and understand. Like I spent a lot of time in that equipment financing one, and I spent a lot of time in there with clients, helping them to understand the value of capitalization. And so when you think about all these great content that's available out there, whether it's in books like The Asset for Canadians or, some of our YouTube videos, they're all do a great job of helping you build your banking system and put it to use. But I'm going to tell you, all of what we do is based on one book, and it's kind of the go-to for all of us. It's this one here, and we all have copies of it. Mine's tagged up and marked up. Richard's has probably got more underlines than mine, but he's been using his book longer than I've been using mine. But it's a tool that we utilize every day to help people understand how capitalization and utilization can make a difference in their lives. So again, as we talk about this, guys, I think about Nelson, and that's a good place to go because, he changed my life. I never expected that. I just happened to hear about this concept, and what do you know? It changed my whole life. I'm doing something I would have never dreamt I was doing. And it's because I believe in it and I know it works. So, as you have questions, I'm just going to encourage you to reach out to your coach and ask him, because that's how you learn.
The question that we're answering is why are people using policies immediately right away versus Nelson's book? He didn't do that. Nelson never says that you can't get started. In fact, in session, in his live training session, he would have said, well, you could, look at how much money was in here earlier. Could you have started doing something earlier? He would have said that in the live session. And this is a thing that support people understand. This book is it's static. You're reading it. There's nothing, there's no living energy on this book. There isn't, it's knowledge, but it's for me, when I read it, it's like Nelson's talking in my head, because it literally reads as though Nelson was talking. But it was really designed as a workbook for a 10-hour seminar. So this is 10 hours of jam-packed one-on-one time with Nelson that you're reading. It takes you 3 hours to read it, which is why you should read it at least 3 times to get the full effect of the 10-hour seminar. Because you would have had to sit with Nelson, and he would have went through these examples. He would have directed you to specific points, and he would have expanded on them, and he would have got you thinking, and he would have ad-lib with stories. Like, as an example, in equipment financing, he talks about self-insuring for collision vehicles, and he tells them one of my favorites is, all of a sudden the Martians come down and they blast, and what's that thing there? That down there, that logging truck. Oh, let's destroy that, and zap! And he melts this logging truck, and he's like, oh, geez, Uncle Nelson, I got to go replace my logging truck. And he talks, so he uses this whole example of a molten pile of metal that's a logging truck. He's like, how often do you go see a logging truck over at the you see it in the mechanic shop, but you don't go see it at the auto body shop. No one's going and repairing what the blogging truck looks like, because it's designed to get beat up. So why are you paying for this extra coverage in that scenario? So everything was a lesson, and you don't get that story when you read the book. Right. There's a ton that you're going to be able to learn by watching our more videos, and recognize that what we're saying here is, as you're putting capital into a system, when you chunk that money in, it gets efficient. All of a sudden you're putting 10,000 in, and then you get 11 back. The next year you put 10 in, you get 12 back. The next year you put 10 in, you get 13. The next year you put 10, you get 15. Yep. And it will continually do that again and again and again. And if you had a bank account that could do that, how many of those would you want to own? It's really that simple.
If I'm putting in that same 10 right now, if I put that same 10 in for the next 40 years and I can get whatever that number is, I put in 10, I can all of a sudden get 40 out. We know that the purchasing power of the dollar is getting diminished every single day. How important is it for us to get more out than what we put in and get that ever increasing pool of financial value? And the last thing that I'll leave with is this. I've noticed in my life that when I worry about things that are outside of my control, life doesn't go real good. I'm very overwhelmed. I get stressed out and my energy drains. But what I love most about the process of becoming your own banker, it's all about what you can do. It's all about the things that are within your control, and it puts the power back in your hands. So to me, it's just a peaceful, stress-free way for me to live my life, because it just allows me to focus on what I focus on everywhere else in my life, what I can control.
Make sure to check out some of the other videos that are probably appearing on the screen right now, and continue your learning process, and make sure you get a copy of that book.